Management Amritsar. I, Snigdha Chaudhary, along with Yamini K, welcome you all to the 9th Annual Finance and Marketing Conclave, Pariprekshya. Pariprekshya gathers eminent thought leaders and industry stalwarts to dissect emerging economic strategies and business trends in the digital era. As participants, we have the privilege of learning from practical insights and strategic thought leadership that will enable us to blend analytical rigor with market innovation to redefine growth, culture, and leadership in the modern enterprise. This conclave is not merely about exchanging knowledge, it's about reimagining how vision, strategy, and innovation intersect to build the business landscape of tomorrow. Dhanam murkhasya vinashaya, sadhoho sadhanam uttamam, dhanam vidya samayuktam, param bhushanam uchyate. Wealth in the hands of the ignorant leads to destruction, but for the wise it becomes a noble means. When wealth is guided by knowledge, it becomes the greatest ornament of life. So, with the blessings of Goddess Saraswati, the Goddess of Knowledge, I kindly invite our distinguished panelists, Director Sir, and honorable faculty members on the stage to join us for lamp lighting and inauguration of this illuminating session.
I would now like to invite our Director Sir, Professor Sameer K. Srivastav, to share his thoughts with us.
Good morning everyone, and welcome to Pariprekshya 9. Sorry for slight delay, but it was very excellent animated talk among the panelists. You will see soon. So that actually thrilled me in the sense people are involved and animated, and you'll have a very good session. So this is something informal. I was addressing to students and my faculty members. Now formally I welcome all the panelists on behalf of I am Amritsar. Lucknow comes to my mind. I've been at Lucknow for 20 years. It comes involuntarily. Welcome on behalf of I am Amritsar community, particularly academic community, faculty and students, and my own behalf to Pariprekshya, and hope we'll have very important, animated and useful discussion, whereas the announcers mentioned strategies could be crafted and lot of brainstorming would be there. The world is full of glorious uncertainties, so we can only plan and try to execute and have some amount of flexibility and plan C's, although plan A should be excellent for most of our strategies. Coming to, I wish to briefly introduce, I am Amritsar, although at least my dear students are aware, maybe for the participants, a brief recap. We are in the 11th years of our, existence, and we are trying to grow. We are engaging in a big way with industry stakeholders, because although academic settings are still traditionally in classrooms, but learning beyond classrooms is much more important for a potential manager and leader. And we don't prepare academics. Some of them may be 2%, 5% at most. We do prepare potential managers and good human beings. So this is where industry interaction becomes very relevant and important. And I am Amritsar keeps on holding such type of conclaves. We do it for HR, we do it for analytics, we do it for operations, strategy, and of course today we have it for marketing and finance. I must congratulate the organizers for selecting very apt themes, very relevant, very topical, something which needs to be actually worked on, and maybe the deliberations will be an eye-opener for not only people within the auditorium or this hall, but maybe beyond this. So that's a great thing. Coming back to what Amritsar offers, we offer a few courses: postgraduate, undergraduate, PhD, postdoctoral as well. All this is available on the website. I am not getting into too much of details, given we have to catch on time and discussions are more important than mere speech for inauguration. But the topics are very relevant for the finance fund unlocking infrastructure potential. And coming from logistics and supply chain background and also finance degree, I can actually appreciate the topic. We have Gati early on in my earlier career, I saw logistics related infrastructure. They have helped the country, although they have come a bit slower than expected. Especially DFC came very late. When I started as an academic, this was conceptualized and was deemed to be completed by 2017 at that point of time. China has taken a big leap in these areas, and now the benchmark is China only. So we need to unlock our potential, and the theme is more from the perspective of infrastructure here. So infrastructure wise also, and again the focus is more on real estate and renewables. We have a distinguished panel. All of them are qualified financial experts. They have very rich experience spanning from 18 plus years onwards, and they have experience across sectors where you'll have a great feel because they bring in not only their present experience but a lot of past experiences also, which help us or which will be deliberated during the discussion. And renewables in particular nowadays, at least on paper now, India is in an energy 500 plus gigawatts, of which, as I saw on the net, I could be wrong, 256 gigawatt is from renewables. Mind it, that includes hydro also. not the new type of renewable, but the traditional one. So I hope it will be a very, very exciting session. For marketing also, which is post-lunch, since the panelists are not there, or they are also as distinguished, and you will get different sectors, and again the topic is very, very relevant. You have named it crafting, branding. Generational shift. Actually, in your text it's something different, but the theme is same. And it could be crafting, it could be reimagining, whatever word or phrase you use. The idea is that you analyze it properly, you look into the proper generational, where you mentioned there are a billion such type of likely customers. So how you get into hyper personalization and so on for this digital savvy customer. I can only probably look at the periphery given my age. Those customers your age or younger than you have a different mindset, totally digital. So again, these have to be reimagined and recrafted, and branding per se will take a paradigm shift, and not necessarily the existing tools. Lot of it will be, even all marketing and advertising is going to take a big shift, in the sense probably incentives will be more towards agents rather than right now you have for platforms or recommender systems or whatever. I think you need to delve deeper into it, and in your questions you can always encourage to ask the panelists. Sometimes maybe in their grind of daily things they may not have looked it from a perspective younger generation look.
Means. At the same time, innovative financial instruments such as the Real Estate Investment Trust and Infrastructure Investment Trust are reshaping the investment landscape. These instruments are not just the financial footnotes, they are the powerful new engines of India's financial ecosystem, democratizing wealth-generating opportunities previously reserved for a few, by enabling mass participation from both retail and institutional investors. This theme seeks to explore how infrastructure and alternative investment can together serve as catalysts of growth, balancing investor returns with the broader objectives of nation building, transparency, and global competitiveness. And with that, I cordially invite Ms. Arpita Gupta and Ms. Kriti Kabra to present today's theme.
Good morning, everyone. Respected dignitaries, faculty members, industry leaders, and fellow participants. I am Kriti, alongside with my co-presenter Arpita. It's an honor to open a session on India's growth story, unlocking infrastructure potential through REITs and InvITs. We will be looking at how India is tackling its massive infrastructure needs by leveraging financial innovations. We'll focus on REITs and InvITs, how they are enabling greater investment in infrastructure, making it possible for both institutions and individuals to participate in the country's growth story. Over the next few minutes, we aim to highlight why these instruments matter, the opportunities they present, and some of the key policy and market trends shaping their future. India's infrastructure needs are massive and still growing. To put the scale in perspective, here's where the country stands. First, closing the infrastructure gap will require an estimated investment of $7.5 to $8.6 trillion by 2047. The largest requirements are in urban infrastructure, while power, roads, and telecom are also key priorities. Fiscal discipline remains a big challenge. India's debt-to-GDP ratio is at 81.4%, with a goal to bring it down to 40% by 2047. Given these constraints, private capital is essential. Lastly, even with advancements like Smart City Mission, much of the India's urban infrastructure is still to be built, showing both progress and the road ahead. Having established the scale of the investment gap, it's evident that private capital is now pivotal to meeting our infrastructure goals. Let's look at how it's driving real change. India is expanding its approach to infrastructure investments by deploying instruments such as InvITs, REITs, and public-private partnerships. This strategy is drawing the interest of substantial players like pension funds, insurance companies, and sovereign wealth entities, who appreciate dependable returns and strong regulatory oversight. Integral to this momentum is policy backing with features like credit support, risk mitigation mechanisms, encouraging the investors' participation. As a consequence, projects reach completion more rapidly and market confidence grows. At the foundation of this progress lies the ongoing need for robust risk-sharing arrangements and a firm regulatory framework to ensure continued engagement from private financiers. Private capital is powering new opportunities in infrastructure, and much of this progress is thanks to REITs and InvITs. By pooling funds, these platforms let investors of all sizes back major real estate and infrastructure projects. Their stock market listing means anyone can join, buy, or exit easily, bringing real flexibility and transparency. Investors benefit too. These instruments turn physical assets into regular income, making infrastructure investment both accessible and rewarding. REITs and InvITs are truly transforming how capital flows and who gets to participate in India's infrastructure story. The next slide illustrates the structure of both REITs and InvITs. At the top is the sponsor, who establishes the trust and transfers assets. A semi-registered trustee acts as a fiduciary on behalf of investors. The investment manager oversees operations and performance, while SPVs hold ownership of specific projects. Finally, unit holders, that are individuals or institutions, receive their proportionate share of the distributable income. This structural hierarchy ensures transparency, governance, and effective management of assets and cash flows. Now, moving from how REITs and InvITs operate, let's look at the different types of options available to the investors. On the left, we see InvITs can be public or private, spanning across sectors like energy, transport, telecom, connecting investors to everything from power grids to highways to communication towers. On the right, REITs are equally flexible, ranging from equity REITs that invest in properties to mortgage and hybrid REITs focusing on loans. They can be privately held or publicly traded. This variety means investors can pick a structure or sector that best fits their goal, making the market far more diverse and accessible than ever before. Now, Arpita will continue.
As we explore the Indian REITs market, the first story is clear. Looking at the graph, returns in participation have surged dramatically since 2020, with the number of REITs and investors increasing each year. On the right, we'll see what driving this. Rapid expansion of portfolios as major players like Brookfield and Mindspace REITs have added record square footage in just 3 years. Stability is a core strength too. These portfolios lock in leases of up to 7 years with top-notch occupancy rates regularly above 88%. That means tenants are committed for the long term, ensuring reliable income streams for investors. Even when market conditions fluctuate, high occupancy and long leases protect against sharp revenue drops, offering predictability and resilience to anyone investing in REITs. India's REIT and InvIT sector is expanding rapidly, driven by the country's urbanization, rising corporate demand, and strong government support. Together, these factors are making the market more dynamic while providing investors with stability and the promise of solid long-term returns. India's InvIT market is booming. Since 2019, assets under management have grown nearly tenfold to $73 billion. There are now 17 InvITs listed, investing across key sectors like roads, power, renewables, and logistics. What sets InvIT apart is performance. The average annual returns of 16.5% surpass REITs, making them especially compelling. Despite this rapid growth, the market scope remains huge, with many coal, solar, and logistics assets still to be tapped. Looking ahead, by 2030, the market will triple in size, reaching to $58 billion as new opportunities continue to emerge. As InvITs and REITs reshape India's investment landscape, it's important to see how they benefit different kinds of investors. For retail investors, InvITs and REITs mean growing payouts with accessible entry into premium assets and high distributions. Yet, the market is still young, leaving plenty of room for more participants. On the institutional side, the sector delivers strong benefits as well. Surging asset values, healthy foreign inflows, attractive yields, and rising market cap, all backed by supportive regulations. Together, these trends are building a robust foundation for all types of investors. Building on the benefits for individual and institutional investors, let's look at the broader impacts these instruments bring. For developer economy, transitioning from the benefits and opportunities, it's crucial to recognize the challenges shaping India's REIT landscape. We're still seeing limited market penetration. Most investors haven't entered this space yet, which keeps participation low. There's also a tendency to concentrate investments in only a few sectors, limiting diversification. Awareness and understandings are areas to build on, especially for new investors who may not know how to engage with REITs effectively. Regulatory volatility adds another layer of complexity, with rules and policies sometimes shifting unexpectedly. Taxation presents its own hurdles, as navigating these structures can be daunting and may discourage investment. Finally, a lack of comprehensive data makes it difficult to benchmark performance or take informed decisions. Tackling these challenges is key to unlocking the true potential of Indian REIT sector moving forward. Moving from the challenges in the REIT space, let's turn to issues facing InvITs in India. India's InvIT sector faces a narrow asset pipeline, so there is only a limited supply of suitable projects ready for investment. Project execution risks like delays and overruns can impact returns and confidence. Investors and managers struggle with a lack of standardized data, making performance comparisons difficult. Distribution and liquidity are still evolving, as investors want easier ways to receive payouts or exit investments. Regulatory fluidity means the rules can change quickly, affecting long-term plans. And finally, global gaps exist because India's InvIT market still doesn't fully match international standards, which can deter cross-border interest. And with this, Kriti will take over.
Building on our understanding of market challenges, let's look at a successful example from the REIT space. Embassy Office Parks REIT. Embassy has redefined standards with over 51 million square feet of Grade A offices spread across India's major cities with strong finance foreign investment backing. Its financial consistency stands out, always above 90% occupancy and a total distribution of 559 crore payout in just quarter 3 of 25 alone. With these financial benchmarks, Embassy's commitment to transparency and full payouts has not just built investors' confidence but has also set the tone for industry's expectations going forward. Building on the example of Embassy REIT leading the way in India, it's important to view our progress in the global context. When we put India in the global context, there is still enormous room to grow. In leading markets like the US, Australia and the UK, REITs amount for over 90% of all listed real estates and make up as much as 6% of total stock market capitalization. By comparison, India's REITs represent only a small fraction, about 12% of listed real estate and 0.3% of total stock market cap. Globally, markets like the US and Australia have decades-long head starts, with far greater depth, participation and integration. This slide shows India's acceleration in its REIT and InvIT journey. There is significant upside both in terms of market share and potential to learn from established international models. Following the comparison between global leaders, let's look at why Singapore's REIT market is a standout example. Singapore offers a remarkably balanced and diverse portfolio covering retail, offices and logistics, all supported by some of the world's most rigorous regulations. This framework ensures strong investor protection and transparency. Investors benefit from consistent returns with yields averaging from 5 to 7% and total performance up to 16% annually. To simply put, Singapore's approach shows how diversity and high standards create reliable investment opportunities that affect global interest. Having seen how global REIT and InvIT models inspire growth and resilience, let's focus on the key policy driving infrastructure progress in India. PM Gati Shakti. PM Gati Shakti's digital integration brings together 16 central ministries on a cutting-edge GIS platform connecting over 1,200 data layers. This initiative enables complete logistics mapping, leading to planning being far more efficient. The impact is clear. India has moved up to 38 in the World's Bank Logistics Performance Index in 2023, reflecting faster project delivery and fewer delays or cost overruns. By promoting green logistics and training thousands of officials, Gati Shakti ensures broad participation and sustainability, pushing India's infrastructure sector into a new era of seamless coordination and data-driven execution. Building on India's push to integrated digital infrastructure, the sector-wise investment chart reveals that most funds are channeled into energy, roads, urban space and railways. This strategic allocation is reinforced by targeted outlays to water, real estate and transport, driving the country's next phase of ambitious development. On the right, the National Infrastructure Pipeline headlines a massive 111 lakh crore investment target spread across more than 6,800 projects by 2030. This robust allocation has double infrastructure capex, expanding the highway networks and is essential for job creation, economic growth and logistics efficiency. REITs and InvITs are essential here, helping to mobilize private capital and sustain momentum in India's infrastructure transformation. Transitioning from India's infrastructure investment roadmap, the National Monetization Pipeline is driving the next wave of public asset value. With target of Rs 6 lakh crore, NMP aims to monetize roads, rail, power and pipelines nationwide. REITs and InvITs help in maximize investments and efficiency. While over 10 types of public assets from ports and airports to highways and pipelines are included in the program. Importantly, the approach retains government ownership, boosts efficiency and actively adopts private capital and global best standards. Regionally, more than 100 key stretches covering thousands of kilometers are mapped across North, East, West and South India, showing the scale and reach of transformative initiative.
After asset monetization gains momentum under the NFP, India's logistics sector is set for transformation with the National Logistics Policy. At the heart of this shift is the Unified Logistics Interface Platform (ULIP), which streamlines data sharing, network planning, document digitalization, and tracking across the supply chain. The country's goal is to bring logistics costs down to 8% of GDP by 2030 by embracing global best practices. Already, the ULIP facilitates 160 crore digital transactions and tracks 75 million containers, a leap in digitalization and transparency, skills development, green supply chain initiatives, and the creation of multimodal logistics parks are being prioritized, all while regulatory reforms continue. With these efforts, India is targeting a spot among the world's top 25 logistics performers. Building on reforms in logistics and supply chain digitalization, Bharatmala Pariyojana stands out as India's massive highway development mission. Of the 34,800 kilometers planned, nearly 20,000 kilometers have already been constructed by Feb 25. This initiative is sharply reducing logistics costs relative to GDP and is vital to boosting trade. By connecting key economic corridors and integrating border and rural stretches, Bharatmala improves travel times, lifts farm incomes, and strengthens regional trade. Ultimately, it's a cornerstone for more reliable supply chains and sustainable nationwide transport networks. Looking ahead, India's infrastructure sector is poised for dynamic expansion into emerging fields, whether it's renewable energy, new mobility services, or advanced logistics. There's a strong and rising emphasis on ESG and green infrastructure, driving investment in sustainable solutions for tomorrow's cities. At the same time, upgrading digital infrastructure will be key, powering integration and efficiency across projects. Improved PPP models promise more innovation through public-private synergy, while the launch of hybrid and thematic funds will cater to a broader spectrum of investor preferences. Finally, fintech-driven platforms are set to increase retail investor participation, bringing more people into growth story and democratizing access to infrastructure investment. After unlocking opportunities across new sectors, REITs and InvITs are now expanding into emerging cities, with Tier 2 and Tier 3 centers now leading real estate demand. The National Modernization Pipeline is supporting more structured investment in these areas. Integration with national infrastructure plans ensures these cities are well connected. And finally, these regulations are helping unlock broader participation. Now, accelerating REITs and InvITs means making things simpler and deeper for everyone. We are seeing policies and taxes made easier, investor education is prioritized, market infrastructure is stronger, and there is a wider pipeline of diverse projects. And better disclosure and governance are bringing greater trust. Fintech and digital platforms are transforming REITs and InvITs. Massive digital reach means wider access. Micro-investing allows everyone to participate. Retail investors are rising fast. Budget reviews are making these options even more attractive. In conclusion, REITs and InvITs are taking on a key strategic role in India's economic growth, helping bridge the infrastructure funding gap by unlocking private capital at scale. Their expansion relies not just on policy support, but on a strong collaborative ecosystem where regulators, investors, and developers work together. Going forward, as digital integration, market depth, and investor participation keep rising, REITs and InvITs are well positioned to drive long-term, sustainable infrastructure development and reshape India's investment landscape for years to come. And as we move forward, the collective efforts of industry stakeholders, policymakers, and investors will be critical in sustaining this momentum. By embracing innovation, strengthening partnerships, and prioritizing transparency, India's REITs and InvITs can truly unlock the country's infrastructure potential, transforming not just our skylines, but the lives and opportunities of millions. Thank you for your time and engagement.
Thank you, Arpita and Kriti. Your presentation was informative and stimulating. The best leaders lead from behind, celebrating others' victories and stepping forward only in times of crisis. They don't seek to be followed out of fear or authority, but because they build trust and lead with empathy. It is now our pleasure to introduce the panel for today's conclave. Starting with Mr. Gautam Pandey, Chief Financial Officer, Stellantis India. Mr. Gautam Pandey is the Chief Financial Officer of Stellantis India, where he leads the financial strategy and operations for globally renowned brands, including Jeep, Citroën, Fiat, and Maserati across India and the South region. With over 2 decades of rich international experience spanning India, ASEAN, and the Asia Pacific, he has developed a deep expertise in P&L management, mergers and acquisitions, treasury, taxation, and financial transformation. Before joining Stellantis, Mr. Pandey held key leadership roles at Nissan, Ford, and Tata Power, where he played a pivotal role in driving strategic and operational initiatives across manufacturing, supply chain, and customer-centric functions. His career reflects a strong focus on building resilient financial systems, enabling business growth and steering transformation during times of change. An alumnus of IIT Delhi and a qualified cost and management accountant with an MCom, Mr. Pandey is also a sought-after speaker at reputed institutions such as IIT Delhi and Amity University. He is deeply engaged in promoting thought leadership on topics related to business transformation, finance innovation, and leadership in a digital era. Outside of work, he is an avid marathoner and fitness enthusiast, embodying discipline and endurance, both in his professional and personal life. Would you please join us on the stage, sir?
Up next, we have our second panelist, Ms. Ranjita Dev. Ms. Ranjita Dev serves as the Chief Investment Officer and Whole-Time Director at Ansin India Energy Yield Trust, where she leads the Trust's investment strategy and decision-making, driving its vision of creating long-term value in India's energy and infrastructure sectors. With over 23 years of extensive experience across private equity, corporate and project finance, and research, Ms. Deo brings a deep understanding of financial markets, risk management, and investment structuring. Throughout her illustrious career, Ms. Deo has held leadership and investment roles at several reputed organizations such as the Aditya Birla Group, Bennett Coleman and Company Limited, and Crystal Research. Her work has spanned strategic investments, infrastructure financing, and developing financial products aimed at driving sustainable growth. She holds a master's degree in management studies from the University of Mumbai and is a CFA charter holder from the CFA Institute, USA, reflecting her strong foundation in finance and analytical excellence. A firm believer in India's potential as a global investment hub, Ms. Deo continues to champion innovative approaches in capital deployment and infrastructure asset management. She remains a dynamic leader and a respected voice in the investment community, continuously shaping the future of India's infrastructure financing landscape. Would you please join us on the stage, ma'am?
Next we have Ms. Ananda Shalini. Ms. Ananda Shalini is a seasoned finance leader and chartered accountant with 20 plus years of cross-sector experience spanning FMCG, consumer durables, healthcare and manufacturing. As Chief Financial Officer of the Cabin Care Group, she spearheads financial strategy, governance and digital transformation initiatives designed to enhance sustainable growth, capital efficiency and shareholder value. Prior to joining Cabin Care, Ms. Shalini held leadership roles at Crompton Greaves Consumer Electricals and PepsiCo India, where she built deep domain expertise in financial transformation, ESG compliance, risk governance frameworks and fund structure strategy. Her strategic perspective positions finance not just as a support function, but as a driver of value creation, especially in India's infrastructure-driven growth story. In addition to her CA qualification, she holds a UK-based ACCA diploma in IFRS and is an active participant in the Confederation of Indian Industry CFO Forum. She is a regular speaker at national forums such as the Future of Finance Summit and Awards and the ET Turning Point. With a strong track record of transforming finance functions into strategic business partners, Ms. Shalini continues to advance Cabin Care's ambition of building a resilient, future-ready enterprise underpinned by disciplined finance processes and innovation. Would you please join us on the stage, ma'am?
Now, I would like to request our next panelist, Mr. Rajat Kumar Gupta. Mr. Rajat Kumar Gupta is a distinguished finance leader with over 30 years of experience in shaping, negotiating, and executing high-value investments and market transactions across diverse sectors. He currently serves as the Chief Financial Officer at Azure Power, one of India's leading renewable energy companies. Mr. Gupta has an exceptional track record in driving growth through mergers and acquisitions, project finance, structured and mezzanine financing, and capital raising from both private and public markets. Throughout his career, he has been instrumental in establishing strong governance frameworks, robust internal controls, and effective risk management systems that ensure financial sustainability and operational excellence. Renowned as a transformational and entrepreneurial leader, Mr. Gupta has successfully set up and scaled businesses from the ground up and revitalized organizations through restructuring, financial optimization, and strategic realignment. His clear, collaborative communication style and deep business acumen have enabled him to work seamlessly with boards, investors, and C-suite executives alike. Mr. Rajat Kumar Gupta continues to exemplify financial leadership and strategic vision in the renewable energy and infrastructure domains, driving sustainable value creation and long-term growth. Would you please join us on the stage, sir? With that being said, let me take this opportunity to heartily invite our director sir to felicitate our esteemed panelists with a token of appreciation.
I request each of my faculty members to do that now. Please start.
I would like to request Dr. Ravi Shankar Pomosa to come on the stage, please. Thank you, Ravi Shankar sir. Now I would like to request Ananya Sal ma'am to come on the stage to felicitate our esteemed panelists. Shreya ma'am. I would also request Dr. Riya ma'am to join us on the stage to take the lead of the conclave and commence today's discussion.
A very good morning to all the panel members and all our dear students. Good morning, Director Sir, and all my fellow colleagues. On behalf of IIM Amritsar, I welcome all of you one more time to this insightful panel discussion. And as we know that the topic of discussion for today is India's growth story and unlocking infrastructure potential, particularly through REITs and InvITs. And we know that infrastructure is going to be India's growth engine, right? So if we want to see India as a $5 trillion economy, we have a vision for that. And we see governments expanding so much, having so much of capital expenditure in the same area, rising FDI in the same area. And in order to enable that, we feel that InvITs and REITs are going to have an important role for us to drive and achieve that $5 trillion economy goal for us. To open the discussion, my first question will be to Mr. Gautam. And how do you think, sir, is infrastructure going to shape India's long-term growth strategy?
Thank you, ma'am. First of all, good morning to all. Thank you, Swasa sir, and thank you the entire faculty, and very privileged to be here, and very lovely to see bright young students, and very happy to interact with you, some of you last evening. Now, going back to this topic, let's see, zoom it out in the context we are in, right? So, India, though we are one of the top 5 economy in the world, if you see in the contrast, we are the largest in terms of population. Our demographic dividend is pretty huge. The resources wise, we are pretty balanced. But when you compare ourselves in the contrast, let's say we compare ourselves in terms of the economic size, we are like about 4 trillion USD economy, as against about 30 trillion US dollar is the USA. Let's not compare US, let's compare the neighboring country, China, as I think Dr. Sivas was telling, the context in which we need to look into it. 19 trillion. And they are still growing at the pace of 4.4% year on year. Though we are growing, say in the range of 7% or so, but if you see the trajectory we are into it, we are far behind. And the huge population we have to look into, and soon, in a couple of years, couple of decades, let's say, this population or the demographic yield will slow down. We have a huge challenge as well as an economy to bring the economy to a sizable, large economy. Okay, we can be happy to be called as top 5 economy in the world, but when you see the per capita income, we are not really good doing that. Now, to break that whole trajectory, how do we take the country forward? And that is where this topic becomes very relevant here. Now, there has been huge investment. I think there was fantastic presentation done by the team. And we touched upon all the key data points, I won't go there. But infrastructure, all of us know, right, that it plays a very clear instrumental role. And there's a very established rule that 2.5 times is the established multiplier. If you invest in infra, that have an impact on the GDP. And hence, there has been huge push from the government standpoint, regulatory standpoint, and also from the industry in many areas. And thus you see a lot of development happening around. And there is a long way to go, and the data points were very clear. That is where the role of these innovative instruments comes into picture. Because with the size of economy we have, and with the gap we are trying to bridge into it, it is not possible just for the government to raise these much of resources. And hence there has to be a very strong participation from the investor community, all class of the investor community, be it your government institutions, the pension funds, the mutual funds, and finally the retail one. considering the fact that our equity market is developing very well. In the last 10 years or so, the size of our equity market, it has grown manifold. I think ma'am will talk more on this front, but if you see the participation of these instruments as a ratio of the overall equity market or the financial market is very, very low. Thus, it brings to the factor that we have huge potential to plug. There is a huge room to grow, and these instruments with the progressive governances, growing awareness, and increasing effort from the industry and the government is going to become very, very relevant. So, as an opening comment, I would like to conclude here that, of course, infrastructure is crucial for the overall economic development, and in order to make that happen, there is a lot of levels to be played, and InvITs and REITs are the major instruments to support in that direction. Thank you.
Yes, thank you. I would like to continue the discussion with Ms. Ananda. And ma'am, would you like to tell us what is your viewpoint onto what do you think that which structural enablers like policy or private capital or we see digital adoption taking place, which is going to make the biggest difference in making infrastructure investment a driver in India's growth strategy?
Thanks, Riya, and thanks IIM Amritsar for having me here. So just to start with the theme or the topic you have here, Pariprekshya, which is about having a perspective. So when I was invited, I was wondering, being from FMCG, how I would be able to contribute on the focused topic of today. And that question prevailed even the day before when we were having an internal discussion. But then I think that facing the consumer over the past 2 decades, my entire journey had been focusing the Indian consumer, and then the perspective from our side as to how these new concepts or solutions that are coming up with respect to infrastructure can impact the end customer or the end consumer. So that way, if I am to see at the 1.2 billion population of our country, with over 8 million touch points or outlets that we call, how do I ensure that my product or my service reaches each and every one of them, so that we grow collectively, both as an organization as well as the country as a whole. So that way, several enablers have been there traditionally, and in the past it was most driven by government policies, where there were always adjustments or compromises from the industry side, where we develop our strategies in line with the policies, or we keep buffers, be it in terms of timelines that need to be met or the cost that we need to endure. All these were dependent, or there was always a cushion that we had to place when it comes to policy. But today, I guess concepts or solutions like REITs and InvITs, which didn't emerge in isolation, but as a result of various policies, be it like GST or RERA or what you call the SEBI regulations, all of them have put together these focused approach from the government side, which I think is playing a great role in bringing in the public-private partnership. So whenever I go through the budget discourses, I always wondered how these PPPs would be achieved. At the end of the day, they are all in papers. How do I see it in reality, and how is it going to impact my organization? So that way, we have come a long way, where GST, for example, as a policy or a reform, has unified supply chain. Digital interventions in terms of be it UPI or collective collation of retail units in the form of OMDCs, the digital networking, which has brought together the entire cycle or entire chain of FMCG or any consumer-facing industry. So that way, policies definitely have played a great role. Digital, as I mentioned, it has brought in people together. Today, my retailer or a spoke in a very remote location can place an order on WhatsApp today. I can provide him with a digital invoice which he is able to access with the kind of networking that the system has created for him. So that way, digital speed has also come in. When it comes to reforms or capital availability, that again has played a vital role, especially with solutions like REIT, where private investments have found their ways in building the infrastructure along with the government. So it's not just the funding from central government-led investments, but also the private investments, which is able to take a certain amount of risk, but also collectively we grow at the same time. So if you ask me which has to be the best enabler, or I believe it's a coordination of all these aspects, so that, for example, the policy is actually giving us the direction, and then digital base is giving us speed, and reforms is giving us that stability in our growth, which makes it more sustainable.
Yeah. So I would like to continue with the discussion. As you said, that you come from extensive experience with FMCG firms. And how do you think that because we talk about India's infrastructure and India's infrastructure growth, how do you think FMCG supply chain depends on infrastructure efficiency of the country?
To put it blunt, we used to invest a whole lot of our capital in building warehouses or leasing them, or building cold chain, which requires a whole amount of investments from FMCG organizations. Especially in our company, in my company, like we have diversified products which need to reach from Assam. We have factories in places like Assam and Haridwar, and our market is predominantly in southern part of the country. So building warehouses became an essential. While GST did help us move around our stocks or move around our trucks seamlessly without much of stoppages, but then things like other projects or policies coming out of Gati Shakti, for example, it has reduced the time frame within which I can get my shampoo or hair color reach a remote location or a rural location. So that way, what used to take 10 to 15 days has come down to 5 to 7 days as of now, as we speak, even in the worst of terrains of northeastern part of our country. So that way, infrastructure in terms of roads has helped a long way. When it comes to logistics infrastructure, yes, it is a necessity for an FMCG or FMCG industry, but whether it would be core for me, of course not. It would be a non-core asset, which is definitely necessary. So these interventions in where collaborative partnership with a REIT or with an InvIT-led corridor, logistics corridor, has helped us a long way, especially in getting the best of costs, because capital efficiency in today's world is the currency to be competitive. So that way, these large-scale facilities have helped us in using our capital elsewhere in building our brands, or be it building into getting our digital network or digital strength further up, so that it goes towards the growth of our organization. So cost competitiveness is something which we have definitely experienced in the past, especially the past 2-3 years. with these kinds of facilities coming in. Renewable energy, of course, while it is still in nascent for mid-sized companies or in certain tiers of the country, yet there still needs to be done, lots needs to be done so that it actually reflects, as I mentioned earlier, it reaches the end consumer, right? So we do have renewable energy facilities, or we are tapping that potential as of now, but it's still in small scale. There is definitely lots to be laid top of it.
Thank you. So as ma'am clearly and rightfully mentioned about the role of renewable energy as well, I would like to take you up here with the question on if we talk about renewable energy, and because these sectors happen to be very capital intensive, right? So how do you think these capital intensive sectors like renewable energy and manufacturing, they'll have an interplay with the logistics, particularly if we talk about developing infrastructure that too sustainably? How do you think that plays a role?
Let me give an example here while I am answering this question. So, I come from automotive sector, right, as you all know. So, there's a live case study. So, we have two manufacturing facilities in the state of Tamil Nadu. One is at a place called Hosur, the other one is the Revolver. One produces the engine and gearboxes, the other one produces the vehicle. Now, one of the plant was having a frequent issue of the power outages, which is not very uncommon in India still, though the macro data suggests that we are power surplus country, but when you go to the layers, you still have a lot of issues. And now this plant is running at the full capacity, producing roughly 3 lakhs engines and 3 lakhs gearboxes, and mainly feeds into the European and the Latin American markets. So you have to supply. If you don't supply, somebody is losing the production of a line. And there was power interruptions. So we initially tried to address this by putting some TG backup, because one is that there's some equipment which, when the power goes off, to bring them up to the service, in particular the heat treatment equipments and all, takes longer time, and the outages are more. So, and again, if you want to put a temporary solutions through DG and all, it's very costly, and then eventually it increases your cost of products. So you are struggling because you got to compete and deliver a particular cost target. Then we thought what we can do. Second step came where we are putting up the solar, rooftop solar. Okay. And with the rooftop solar, this project is kind of ongoing right now, and phase has been done. It can't help standalone. You got to have the energy storage also. So, I mean, this problem is still under being solved, but increasingly it is being solved by putting up the measures. 10 years before, 10 years back, you could not have thought solving this problem by putting a solar. I think Rajat will talk more from his experience, but the cost of the solar has gone down significantly. Now, it is very comparable to what we get from the thermal, and that makes these projects more viable for us to look into it. Now, to solve these problems from infrastructure and logistics into the industry, there is a very strong interplay. In my opening comment, I was telling that we want to grow. Now, if you want to grow the GDP from 4.2 trillion USD to, let's say, 6 trillion or 7 trillion, forget about China, 19 trillion, by the time you will be growing to 8, there will probably be 25. You have to improve the manufacturing. And our own government, Niti Aayog, has been estimating to take the manufacturing share of the GDP from current about 15% to 25%. But if you see the data in the last 10 years, it's not growing. It's not growing. There was a huge decoupling happening in the past because of geopolitical issues from China. Last 2 years, we have been seeing a lot of things happening. Now, being into automotive, we try to gain the share. Okay, so in the automotive, most of the global companies don't just produce and sell in India. Okay, they produce for the global needs also, because you are into a low-cost country. So you have a lot of suppliers, you've got a lot of engineers who develop, and you feed into the global. That's also one of the major business. In fact, in terms of value, if I tell you, we do 2/3 of the business, which is the export-oriented business, and only 1/3 goes to the domestic market. So, a lot of opportunity coming out. But when it comes for supporting back to the opportunities, did we really capitalize? Did the majority of the decoupling benefit from China came to India? It's a debatable topic, but answer is probably no, to the best of my knowledge from my sector. Because of the simple reason that we are still having the challenges in the associated areas, which is not making still the manufacturing very competitive. Example number one, the supply chain cycle is pretty high. Okay, so from the factory to the port clearance, it takes about 10 to 12 days. Okay, even more in many cases. The storage facilities in the factory, like in your case, the FMCG, but in the power, for example, batteries. Battery is very sensitive commodity. You don't have in India. You have to store. And then you have to store in a cold storage facility. You can't store into the normal facility. Then you need the infrastructure. Every time, let's say, in order to get your goods from your X factory to the customer factory, if it takes 30 days, if you are taking 10 days just in your port, from your port, then you are not being efficient. The 5 days which is being lost in this process can be very critical if you see the long term. Similarly, the input cost. Power is one of them which we all can correlate, but then you have got other factors also. Say for example, steel. Steel, India being the very strong in terms of the raw material, we export a lot of raw ores to the China actually. If you see into Odisha and other bits, there is a lot of exportations of the ores are happening. We are not able to produce the high grades of the steel. Even now, most of the automobile companies are importing the high grade rolling steel from either from China or from Korea. Okay. Now, why we are not able to produce them in India? So one is that of course technological factors. The other is that the logistical hurdle. Of course, other factors play a role as well. So if we want to solve this problem and look into the larger perspective, how can we grow the economy and bring our GDP to one of the best in the world and the potential we are having, we definitely need to have the very strong interplay between the infrastructure and the manufacturing and the service sector. Finally, to conclude this, I see this problem as it goes forward can lead to a lot of improvement and add to a lot of the competitiveness for the sectors, in particular for manufacturing. And that is probably the reason why infrastructure is being pushed a lot. Because one thing is clear from government standpoint and policymaker standpoint that we definitely want the manufacturing to grow. And it is very critical not only for GDP but also for employment in the larger social aspect, because we want employment for our people. And hence, infrastructure with its supports on the logistics, reducing the logistics timeline, reducing the input cost, and finally reducing and improving the quality of the delivery is going to play a pivotal role. I see a lot of things already happening. Recently, Prime Minister announced one of the major ports in the state of Maharashtra, right? That is going to be fourth largest in the world. So ports quality is getting better. In the last recent years, you see many new ports have came up with a very good infrastructure. Connectivity to the ports are getting much better. I think giving example from Maharashtra, from Navashaba port to the factories in Pune used to take longer time. Now it's taking a little lesser time. So road infrastructure is getting better. I think few areas, notably in the power and all, there is still a lot of work to be done. Not only in the generation side, but also on the transmission and the distribution side. And where infrastructure-led initiatives are going to be pivotal. So let's look forward that how in large we are solving this major issue and which becomes the catalyst for the larger development of the economy.
Yes. Thank you. So I think now we've sort of created an understanding that infrastructure is going to be the backbone of any economy's growth. And as we sit here and we want to dwell more into how do REITs and InvITs play an important role in sort of driving this infrastructure growth for our country. As the presentation also mentioned that InvITs and REITs bring a lot of benefits from the investor point of view, from capital point of view. And with that, I would like to ask Ms. Ranjita, what do you think, as the presentation mentioned that it's been quite recent in India, the growth of InvITs and REITs. So what do you think is driving the rise of these REITs and InvITs in the Indian financial ecosystem?
Investment in infrastructure is one part of the overall story, right? The government, as we know that we have a very large national infrastructure plan, which is about 111 lakh crore. But investment is one part of the spectrum, but the other part is also unlocking value for these infrastructure investments, because both the government and the developers cannot endlessly keep investing capital. Somewhere this capital also has to be recycled so that fresh investments can be created. So the government, announced a national monetization plan alongside the NIP, which is about 5 lakh crore kind of an investment. And this NMP has been hugely successful. We've seen monetization through various routes, which InvITs and REITs are one part of it. In the road sector, we have seen toll, operate and transfer model that has happened, for monetization. Coal blocks have been auctioned, and there has been very good participation from a host of foreign players, including the likes of Macquarie and Brookfield and Blackstone in this particular monetization plan. And what attracts this foreign capital is also there is a pool of very de-risked assets with very stable off-takers. So, there is huge demand for, in terms of the NMP. Seeing this very positive response, the NMP for the next target for the NMP is been doubled to almost like 10 lakh crore, which again creates a huge opportunity, not just for developers, through the NIP, but also for asset managers and pension funds who bring in very, very stable capital. Now coming to REITs and InvITs, so globally this is a sector that has been in existence for close to about 60 years now. Especially in the US. It started in the US, and globally, if you see the market cap of all the REITs and InvITs together, it is about 1.9 trillion. US being the largest market, again because regulations etc. are much older, but India is a very, very small fraction of this. Our market cap is close to about $19 billion, for all the REITs and InvITs combined. So just to give a backdrop, regulation has started in 2016 when the regulator decided that we need some sort of a vehicle to monetize infrastructure investments. And at that point in time, the regulation was very, very stringent in terms of REITs and InvITs. The regulator wanted only institutional capital to come in. The framework, so the minimum ticket size was only like a 10 lakh rupees kind of a minimum ticket size. There were various frameworks. So public listing, for example, was compulsory. Over time, this regulation has evolved very, very positively. There has been, the regulations around related party transactions. Corporate governance is extremely good in the case of InvITs. Listing is compulsory, so you can be private listed or publicly listed. There are various options available. So there's a lot of transparency and governance. So even 50% of your board has to be independent. So all of this creates a lot of confidence in terms of the investor mindset. And as we speak today, from 2017 till now, so the first InvIT IPO happened in 2017 with IRB and IndiGrid. And cut to today, we have 25 InvITs and 5 REITs, cumulatively about a 9 lakh crore kind of an AUM that we see today. And interestingly, about 50% of this equity capital, so about 2.5 lakh crore of equity capital has been raised. Interestingly, about half of this equity capital is from foreign players, given the very good governance frameworks that the regulator has evolved. We domestic institutional participation today is still fairly small, but given the size of the NMP, the kind of opportunities that we have and the governance framework that we have, we see this sector, increasing at a very fast pace, as also explained in the presentation earlier. And the way I would look at this trajectory is, akin to a mutual fund. So obviously, infrastructure investment will grow, monetization will grow. So it will perhaps move, in line with the mutual fund kind of an industry. Where if we see AUM 10 years back was, somewhere around 7 or 8 lakh crore. Today we are at 74 lakh crore. So InvITs, to my mind, next decade again will be very good. Maybe the growth will be akin to what has happened in asset management.
Thank you. So I would like to bring Mr. Rajat into the discussion now. And as she also rightly pointed out about role of InvITs and REITs from the investor point as well. So how do you think that these instruments can change the landscape of long-term investing? We can talk about retail investors as well as how it changes the landscape for institutional investors. So what are your thoughts on that?
Good morning to all, and thank you very much for inviting me to be here. I'm very glad to present with all of you. So, good morning to all. I'm not seeing any responses from any of you. Good morning. Good morning. I think that's good. So, wake up all, please. I saw some shoulders dropping in the audience. So, anyway, I'll just touch upon a few things before I come to the specific question. How infrastructure affects our life. Can you think about it? Basic three things if you think about telephone, for example, roads, for example, electricity, for example. You ask your parents 50 years back, probably they have to wait for 10 years to get a telephone line, for example. Okay? There are a few hours of load shedding in your shower houses, for example. Could you run free air conditioner in your house, for example? Could you drive out from your home to a faraway place comfortably? So think about that, for example. That is what infrastructure is. Okay? Alright? So just give how infrastructure touches our life on a day-to-day basis. That's the first point I thought I was bring it to you. For example, way back in 1996, when I started working in telecom, when the telecom sector got privatized or government opened it up, can you imagine what was India's data density? 0.43. So for every 100 people, there was a 0.43 telephone line in India. And in all developing worlds, it is about more than 80-85%. Alright? Today, India has more than 80% density. So we have come close to better than of the developed world. Alright? All of you probably carrying 2 telephones, 2 mobile phones in your pockets, for example. Right? Okay? So the point of infrastructure is you give telephone, people will speak. You provide roads, people will drive. You provide electricity, people will consume. And that's how infrastructure contributes to the economic growth. Okay? As Gautam said, I'm saying it's every rupee spent has a 2.5x impact on the GDP. So that's how the infrastructure touches our life on a daily basis. And infrastructure by nature is very capital intensive. It's long gestation. Okay. Any project, for example, if you put a telecom project, it's about 6 to 7 years it takes for a break. Alright. I'm talking about fixed time. If you take GSM, probably 3 years, for example. You take thermal plant, it will take about 4 years, 4.5 years to construct, another 3 years to break even, for example. Renewable energy, probably 18 months, 24 minutes to construct. It will become cash positive in the first year itself, probably, but book positive or PAT positive over next 4 years, for example. Because the interest rates, the depreciation rates are very high. Alright? So that's a construct. So you need to understand where we are constrained. We are constrained in terms of capital. We are constrained in terms of the entrepreneurs who can take this risk. Okay? And on top of it, there is a high regulatory uncertainty. Okay? The government drives the policies. I'll give a very simple example, right? I was working on the first telecom project way back in 1996. I was working on the GSM project, which you all know today is Bharti Hexagon. Alright? That was a project being put up in Rajasthan. We decided the project cost, went for financing. The project cost in those days costed $300 million. There was no lender in India to fund that project. Because they didn't understand telecom. What is telecom? So ultimately we have to go to our equipment supplier and say, please give us suppliers that credit. Alright? Suppliers that credit came in. And then when we bring the viability, the tariff was 16 rupees, for example. 16 rupees for an incoming minute, 16 rupees for an outgoing minute. What you would do, my wife used to give me a missed call so that I don't spend 16 rupees on my phone. And then I used to call back from a landline. Alright? So this is interesting perspective, how the government policies shape up. Alright? The government says telecom tariff 16 rupees, incoming, outgoing. The project was totally unviable. We did a statistical model. The project would say 100,000 subscribers over 10 years. What are we doing? $300 million, 100,000 subscribers, 1 lakh rupees of our handset cost. Who will buy? Think about it. Would you buy a phone? What 1 lakh rupees today? Probably answer is yes. You want to buy iPhone 16 or 17? Not in those days, right? So that is an interesting point I just want to bring in how government policy, regulation, capacity to put that project to take risk and capital shapes infrastructure. And then we said India was the first country which opened GSM first. Globally, landline came first, then followed by GSM, then followed by data. In India, GSM came first and landline came later. So I'm just trying to give a perspective, and then GSM suddenly followed by CDN. there was total confusion. What is mobile? CDM is as mobile as a GSM. What I'm trying to say, the government policy, for example, created a big challenge in those days. How to promote a landline, because everybody said, I would rather buy a GSM phone. Why should I take a landline connection? A landline connection from a developer perspective or telecom operator perspective, a Bharti Airtel perspective, would cost 50,000 rupees to give you a telephone connection versus a GSM connection, they will spend only 5,000 rupees. And then tariff, for example, a GSM will cost you 15 rupees, a landline will cost you 1 rupee per minute, for example. There will have inverted tariff structure, which means you consume more, you pay a higher tariff. Today also in power you have inverted structure. You consume more, you pay more tariff. Right? So because the context, where you can correlate how we talk about infrastructure, we talk about, government policy, we talk about capital, why they are so relevant and how it touches our daily lives. Today you feel very comfortable sitting in this hall with air conditioner. 20 years back probably that was the case. Even for Bajaj Chetak you have to wait for 5 years. Right? So just to give a context of how our lives have changed with the infrastructure revolution which has come to India. Right? Now coming way forward, still there is a lot of things to cover. Probably as everybody mentioned here, still behind the developed markets in terms of the infrastructure we have in India. Right? So the question was
how do these instruments of REITs and InvITs have an importance or play a role from investors' point of view? We can talk about the retail investors, we can talk about the institutional investors as well.
Yes. So the point is that every infrastructure project is highly capital intensive and long gestation in terms of construction period and break even of start generating returns. And in that context, the capital you put in get locked in over a longer period of time. So for a renewable project it would be 3 years, for a thermal about 5 to 7 years, for a telecom again 5 years, for a hospital. Hospital is infrastructure in a way, alright? It takes 7 years to break even. For example, right? Everything is where the capital gets locked in. So how do you have 100 rupees you spend, now where you will spend 100 rupees and 400 rupees? You have another 100 rupees, right? You go out with your friends for a dinner, you spend your money, you lost your pocket money, consume your pocket money, you go to your parents again, give please more money this month. After birthday to celebrate of my friend, right? You need to give him a gift, right? Same thing applies. Infrastructure, the capital. Where the capital comes from. So capital comes from large players, banks, institutions, government, investors, right? Government has a lot of socio-economic responsibilities. They cannot fund capital infinitely. So then comes the private capital. Who is willing to take a 5-7 year risk? And typically infrastructure projects give you very utility-based returns. So for example, in stock markets you can get 15%, 20% return. Infrastructure project, you will over a period of time, you will make 10, 12, 13% returns. But they are consistent returns, for example. Right? The class of investors who will contribute to infrastructure are very different. They need to be long-term investors, they need to be willing to take risks. Risks in not terms of returns, risk in terms of construction risk, risk in terms of the regulatory risk, the government policy change. And that's where the public, private and retail sources of capital come into picture. Now, developer who has put into an infrastructure project, how will he go to the next project unless he is able to recycle what Ranjita was saying? He needs to recycle capital needs, he needs to get his capital back, he will again leverage on an equity basis and put in a new project. And therefore, for example, the public market structures or products, whether it is shares, whether it's REITs, whether InvITs comes into picture. So, how can you own today at your level a real estate asset or a power plant? Guys, can you own on your own? But through a REIT or InvIT you can own. That's the difference. So even a REIT or an InvIT allows you to buy 1 unit of that asset and you are part owner of a power or a thermal or a renewable or a road or a real estate. So that is where a REIT or an InvIT allows. It allows segregation or partial ownership of assets. The structure is that. It is similar to shares. So So you own, for example, one share of capital, for example, right? Okay, it gives you ownership of that company. But the difference is, in that or here, what the government has made it mandatory is 90% of your cash flows have to be used for repaying back to the unit holders. So they earn regular returns. So that's where the retail investment comes in picture, right? From the capital participants, it becomes relevant when they do a InvIT or a lease. A REIT, they can transfer that asset to a REIT InvIT. They get the capital back, they can redeploy, raise fresh debt against that, and re-leverage and raise a new project. In that context, REIT InvITs becomes relevant. Now for the retail investors, as I said, it enables you to own assets. Okay, so you can diversify a portfolio, you can own a transmission InvIT, you can own a renewable energy InvIT, you can own a real estate REIT, you can own a telecom InvIT, a data center InvIT, for example. The diversification is there. There's very clear tax benefits you get, okay, because there is a pass-through of tax structures. You are taxed at your marginal rate of taxes, somebody at 42%, somebody at 30%, for example. So that depends upon your own ownership and dividends income. From that retail, it allows in their mandatory listed, even the private InvITs which are listed, which may not be that frequently traded, they allow you to own one type. Buy a house today, you have to probably wait for 6 months to consume the selling process. A REIT you can sell tomorrow on the stock exchange. So there's a high liquidity is available to you. Alright. And the advantage is that from a developer perspective, it allows continuously transfer the assets to a REIT or an InvIT, recap its capital back. So it's like, for example, if I have 5 projects, I may select to transfer 2 projects to a REIT, okay? And 6 months down the line, I believe now I have a new opportunity for building a new fresh project. And therefore, I would like to transfer the 3rd project and raise money for that. So it's at my discretion, at my own timing, I can do that. So those are flexibility these products offer. All right. Of course, there are a lot of regulatory constraints which are going to protect retail investors. All right. The most important thing which I just touched upon was the governance frameworks. Okay. Well, the government has put a lot of governance frameworks, but the real issue is that at what value you transfer an asset to a REIT or an InvIT. So a sponsor would always be inclined to sell it to maximum price, but it should be arm's length. Alright. So those are the constraints. While I'm saying, the regulations are there, it's still always, the fair is possible. So that's a point. Does that answer your question?
Yes, definitely. So we spoke about how investors can reap benefits out of REITs and InvITs. Just to ask you, Ms. Ranjita, as to what do you think is the perspective of corporates on REITs and InvITs? What I mean to ask here is that, do you think that InvITs and REITs can act as a tool for deleveraging corporate balance sheets?
So InvITs and REITs, the basic philosophy itself is, to recycle capital and, and enable fresh investments. For developers, obviously including the Government of India, and we have seen very practical examples, right, across various developers. For example, the National Highway Authority of India itself has leverage of about 3.5 lakh crore. And they have monetized, they kind of deleveraged this through InvIT and also through the TOT mechanism. So NHAI itself runs an InvIT today of about close to 60,000 crores. Power Grid itself as well, today, which is the largest, the government-owned transmission line provider. They've also deleveraged balance sheet to a large extent, to some extent, by running their own, Power Grid InvIT. Similarly, we have various road players and various power transmissions. For example, Sterlite Power, which runs IndiGrid, has transferred close to 20,000 crore worth of assets, into the IndiGrid InvIT, and that has freed up its balance sheet to kind of enable new investments. In Reliance Industries as well, we have an example where telecom, logistics, they also have a pipeline which has been transferred into an InvIT framework. And all of this, again gets into kind of a fresh investment. And there is also huge investor appetite. It's not just win-win. It's again a win-win for both the developers and the investors as well. Because for the investors also, what they get is a yield generation, because all of these assets have underlying contracts of 15 to 20 years. So there is a very stable yield kind of a generation that happens from these assets. And obviously, as the pipeline grows and with a steady state pipeline of assets, you also see capital appreciation. So from an investor perspective, both there is yield and growth. So total returns, as was mentioned in the presentation, comes to about 13 to 14% as of now, given the growth component as well. And so this is increasingly very, very attractive to long-term pension funds, insurance companies. So today, close to about 50% of investment has come from foreign investors, but again, domestic investors such as retail and other institutional investors, also this will become going forward.
Thank you. So, as Mr. Rajat, you touched upon the idea of InvITs and REITs sort of taking a role into recycling of capital, and as Ms. Ranjita also mentioned the same. Would you like to tell us about how does these financial instruments play an important role in corporate leverage decisions? When we talk about recycling of capital, how do you think going forward they are going to impact corporate leverage decisions?
Yeah. So the point I just made was that being capital intensive, and therefore they are highly leveraged projects. A typical manufacturing project, you will see 50 to 80 equity, and an infrastructure project, you will typically see minimum of 70-75% to as high as 85%. Okay. So leverages in typical infrastructure projects are very high. Alright. And for every, say for example, 20 rupees, 25 rupees, the promoter puts in, there is around 75-80 rupees of debt. Alright. And therefore it restrains them from raising fresh debt. Okay, for any new project, they have to again do the same thing. They have to put in 20 rupees and raise 75 or 80 rupees of debt. Alright. So when you do the recycling of assets by transferring them to a REIT or InvITs, alright, they first retain part of the equity they have put in. Alright. And that debt which is sitting on the promoter balance sheet or the company's balance sheet gets transferred to a REIT or an InvIT. Therefore, the balance sheet gets deleveraged. The fresh capital comes in, and same therefore a new asset is put in. And why would you should ask why would you do that? Because the REITs even guidelines say that 80% of the assets have to be operational, and that's why. So only once an asset becomes operational, you can transfer it, or an asset is closer to commission, you can transfer it. You cannot put a greenfield infrastructure asset, and hence this leveraging, deleveraging, recycling becomes very rare. The other important thing is that in a typical project finance for a greenfield project, the debt sizing or asset or project financing is linked with the project cost. India, while is evolving in terms of project financing, we still do project financing on a debt equity basis. So letters will say we will not go beyond 75% of debt or 70% of debt of the total project cost. Internationally, project financing is done on the basis of the cash flow, the ability to service debt. Okay, so in the greenfield stage, while India is still not moved to a cash flow based financing, we are still capped at the debt equity basis of financing. Once you transfer the assets to or operating assets to a REIT or InvIT, where the criteria of leveraging is very different than a project cost basis of debt equity or financing, where typically if the regulations today say, and they make it a bit subjective to those, it is linked to the fair value of the asset. Alright. So if the asset is rated less than AAA, okay, based on the fair value of the asset, you can raise 50% of the fair value as debt. Now it is not linked to the project cost. So let's give a simple example. If the project cost is 100 rupees and the project has become operational, let me give an example of a renewable energy project. Typical renewable energy project is, once it has become operational based upon FCFE, DCF, you guys understand, right? It will typically be valued at about 1.7 to 1.9x of book value. I'm just giving thumb rule numbers. So if an infrastructure project which is financed at 100 rupees, at 75 rupees of debt, the moment it gets transferred to a REIT, for example, and let's say consider value 150 rupees, okay, and it is 50% debt, you can definitely raise 75 rupees of debt, okay. So you're replacing the original debt with the new debt at the InvIT. But suppose the asset is valued at 1.7, and therefore if the asset is transferred to 150 rupees or 180 rupees, then that 50% of that would be 90 rupees, for example. So you are able to leverage higher a REIT and use that money, okay? Because when the InvIT or a REIT raises that debt is used to repay the lenders. So again, the lenders have the capital back, and they will be happy to lend the same promoter again for a new project based upon his track record. This is how InvIT and REIT helps in capital structure. Now the moment the asset is very stable, it has an efficient track record of cash flows and operations, and the rating improves AAA, you can leverage it to 70%. So means on the same, now with passage of time, that 180 rupees of value would have come down to 160 rupees. Because unlike real estate, where the life is infinite, in an InvIT, all these infrastructure projects, transmission has 35 years life, renewable energy has 25 years PPA, for example, right? They have finite life, and basis that with passage of time the value comes down. But because as now the asset is rated higher, right? So that 160 rupees, 180 rupees now valued at 150 rupees, but still the value is, you can raise 70% of it. So ability to leverage a REIT remains high with the stable cash flows, track record, better rating, etc. I'm trying to give examples so that you can correlate what I'm trying to say.
Thank you. With that, I would like to ask Mr. Gautam. We talk about how investors can reap a lot of benefit with REITs and InvITs. So just to increase or better the investor confidence into this infrastructure-linked vehicles, what do you think can play an important role? Like, can there be taxation policies or there can be compliance frameworks? What do you think can actually make these more investor-friendly?
Okay, so the governance which was announced in 2016, given the fact that I think Anita very clearly summarized in the beginning, and the presentation from the students was also very clear. Given the fact that right now the prime beneficiary of the REITs are dominantly the government infrastructure project, and then the energy comes second, there is a very strong governance framework existing. The instrumental part here is that how it is being dealt with and how in practice being followed. Essentially, if you see the framework in which these REITs are working, this 3-tier framework, right? In the beginning you have got the sponsors, then you have got the trustees, then you have got the fund managers, and then finally you have got the individual SPVs also. Now, while the fund managers are playing the critical role and they are managing day-to-day and all the governance requirement, disclosures, reporting, etc., the trustees plays very critical instrument role here, right? They are the one who is acting as a board in this case and providing a skeleton governance support. Now, as long as these two frameworks are working in tandem, okay, and there is very robust follow-up in terms of the reporting, governance, disclosure, the conflict of interest. There is enough checks and balance built in here. Notably, you can't retain the cash flow, you have to dispose 90% of it every year. There is a 3-tier approach in terms of what you can lend, the leveraging ratios, okay, depending upon the credit rating. I think that's very well summarized. AAA is something which is very, very hard to get into. Okay, so AAA rating means you're involved with the rating agencies, and somebody else is watching your cash flows, your NPVs, your projections, your assumptions behind the same. In all these valuation topic, be it rates or anything else, or for that matter any other valuations what we do in the day-to-day life, what is essentially fundamental is what are the underlying assumptions. Okay, as an investor and as a governance, we always need to know what are the driving factors behind all these valuations, projections, business cases? Whatever you can complex the topics with multi-tier governance and other things, eventually fundamentally it goes that are we watching those fundamental of the business levers carefully? Okay? And then the operating aspect comes into picture, like how the promoters or the trustees, their credibilities are and how they are managing. And then finally, as I told, that the credit rating to play a role. So as long as we are able to do a very fair interplay between these 3-4 factors, and we are watching carefully with a very strong governance structure already in place. I think the governance structure is pretty strong here, and the risk quotient is fairly balanced. Okay. Having said so, as it always being the saying that the grass looks greener always, right? When you see from far, as you get closer, it's not the case. I was expecting your research report, students, to also demonstrate the performance of those funds, like 25 of the REITs and 5 or 6 of the InvITs, not many in the country, right? Is all the funds are having a growth in terms of the NPVs? And I think Pranjita, you can tell that there are still few, and several of them, who are into negative trajectory. So when we talk into products like this, we tend to get into the brighter side of the picture a bit more. But when you see the other side, that there are so many cases where the assumptions are not holding good or failing to assert those assumptions, and again the root cause will go to the same reasons. So finally, as a final reminders, and it's important for our students when you go into real life. First, do look into your key physicals, so to say, or key assumptions underlying any investment proposals, business cases, or the review propositions. Second is to that, keep relooking them, because it's not the same world. And the other thing which we have not touched as yet is that all these infra projects are dependent upon a certain, larger picture, in particular in the infrastructure domain. Let's say you put up a hydro project, large hydro project, and you got a major investment and you put a major instrument towards the same. Now there is a shift in the climate pattern happening all across the country, all across the globe. If there is change in the pattern of the rain and the reservoirs are getting changed, there is issues. If there is any geopolitical tensions being emerging, there is an issue. If there is an unrest of the socio-economic on that particular area, we have seen already in many of the projects, there is an issue. Only good thing in these projects is that they are all mostly live projects or near completions or earning generating propositions. So the risk of unknown is relatively less because it's already up and running by and large. But it's still important that we keep a watch on the physicals and keep looking into the driving factors of the business.
Just like to one point on the governance. So the point you see from the presentation, so it's a Blackstone, it's the embassy, for example, when we talk about. Okay. Why they have been able to get the largest of the REITs in the market and why not other real estate developers not able to get it? Think about it. One reason? Any of you? It's the governance. Because anything which is owned by foreign investors, private equity investors is perceived to be better governed than what is owned, especially on the real estate side. Alright. That's a point which I just thought of give an example for. There are many other smaller real estate investors. The largest have been the ones which are owned by foreign investors. So on the telecom data side, for example, GIC for example, on the renewable side for example. Okay, while renewable the issue is not so much of privately or projects pretty straightforward. It's lack of understanding of the sector and some of the things involving. But still, some of those GICs, KKRs, who are the largest investors, whose investors have gone ahead and got much more traction than anything else. So the point is governance, and that's what is very relevant. So it's not only how you govern, the perception of governance also matters.
Yeah. So, as Mr. Gautam had rightly mentioned about the risks, Like we should not forget the downs of these financial innovative vehicles or new innovations. So just to bring in the perspective, you're talking about financial innovation, but at the same time, risk management also becomes absolutely essential for that, right? And on that, I would like to take thoughts from all of you, starting with Mr. Rajat, as to how do you think CFOs or CIOs or the fund managers, they go on to balance these aggressive growth policies or instruments with risk discipline?
So I'll just put a comment here. It is not aggressive policies or aggressive instruments.
Yeah.
So from a CFO perspective, the biggest challenge is balancing growth and managing risk. And that is a conflict in a way between the business and the finance. Business by nature always wants to grow fast. They want to be aggressive, for example. And as finance, your job is, of course, compliance, risk management, and of course to make the resources available. Alright? So that's a conflict which is there across organizations, across sectors. And that's where the business finance partnership becomes very relevant. Okay. So having said that, I think the biggest important factor for CFOs is to start understanding the business. Unless until they understand the way the business is being done. What are the things which are the business drivers? Alright. Okay. Nuts and bolts of business, for example. They cannot contribute to business and therefore they cannot assess risk. And I'm talking about risk not in terms of, if you talk about forex risk, interest rate risk, for example, while they're difficult to predict, they're still easy to understand. But I'm talking about the business risk, for example. Where is, for example, where is the renewable energy certificates demand going? Which DISCOM is going to have more of take? Which DISCOM is likely to default? What could be the supply constraints? I'm tying to the Chinese module supplier, or if now the ALM becoming mandatory, from which of the domestic module manufacturer should I take? Should I go into behind the balance sheet? Should I go into the ratings? Will they able to service my supplies over the next 20 years in terms of spares? Okay. When I'm seeking an insurance, for example, what sort of insurance cover should I seek? Okay. Is it only the typical fire policy or risk policy should go by for a business risk, loss of revenue, for example? The question comes in that what cost of going to incur the moment I say that I will take a loss of revenue, for example, right? Those are the risks we are talking about. Okay. There have been so many instances where the Chinese module suppliers have gone bust. Okay. The warranties they provide for 20 years, which is supposed to leave a module life, no more exists, for example. Today, if we have to replace those modules, either we have to reconfigure the plant, because those configuration of modules or that make of modules from that supplier is not available. Okay. So those are the risks we are talking about. And that's when, first of all, the understanding of the business is very critical. Alright? And then the balancing comes to picture. Alright? So the best way to manage risk is, of course, to be data-centric. Alright? For example, you talk about foreign exchange risk. What assumptions will you take for, if you have to put an imported component, cost for hedging for that? Right? Today, for example, forward premiums are about 2.5% for 1 year and 2.9% for 3 years, or 2 years, for example. If you go 3 years back, the forward premiums were in the range of 4.5%. Did you know 2 years down the line what was forward premium? So how do you mitigate that risk? How do you assess that risk? What assumption should you put in? Right? You look at historically, rupee has been depreciating 3% on average per annum. But if you take into account every 5 to 6 years, there will be one particular year where the rupee has depreciated more than 10%. Now, if your project falls in that year, when you're importing, you're Roger. I'm putting a very simple example. That's where the risk assessment, risk mitigation comes into picture. Your judgment, right? So probably, there's no right answer for this example. But probably I'll say the forward premiums are going at 2.5%. I believe there could be 3 months delay. Instead of taking a 1 year forward premium, I'll take a 2-way forward team. Today, if I'm going to lock in, that could be one way, for example. It commensurates with the, I'm simply giving an example to make you understand what I'm talking about, right? It commensurates with the average 3% rupee depreciation happening over the last 40 years in the country, for example, right? So there are bases where you need to assess risk, question it, is the best way to assess risk, okay, can you do it definitely, alright? There can be certain risks which are necessarily not measurable, okay? So how do you take a softer aspect of this? For example, you are key manager person tomorrow if your project head leaves, okay? So there's a second line of management team in place, for example, right? Okay. What if a COVID-like situation happens? Nobody anticipated COVID, right? All our plans went haywire. We certainly thought we are going to be 5 years back in life. All of us thought so. At least I thought so, right? So you have to plan for certain things. You need to have certain contingency provisions. Okay. That's a way, So think about what is risk first of all. Risk is something which is something unknown. So you, in the process, you try to evaluate what unknown can happen. And I can bet you, despite your best of assessments, people sitting here, we can say that there will always be some surprises which will come up. And especially, that is the beauty of infrastructure projects. Okay? In this country, being highly regulated and being highly prone to foreign capital, foreign investors. Okay? So that is a risk, for example. So that's the way I will put in risk. So you have to constantly on our edge, you have to constantly think, what can go wrong, what's the best basis of implementing it, alright, evaluate options, okay, and try to put our risk mitigating framework.
Just to pick up from what Rajat mentioned, who wouldn't want something placed on a golden plate and given to you ready-made, be it instant noodles or a ready-to-eat product which is available at your doorstep? Who would don't want to have such kind of a facility nearby? Well, as a CFO who is expected to get things done yesterday, there are now several resources and tools and enablers and structure, be it in infrastructure, physical infrastructure or digital infrastructure. There are several enablers for me which I can incorporate into my system so that I can deliver the result that is expected by the business or ease of decision making or speed of decision making. Now, whether I would want to take everything that comes my way, believing that it's going to give me the result that I'm expecting, I guess I won't be doing that. So sense and safety is something which we would definitely want to look into. That is where the balancing of growth or value creation and the risk management comes into play. So every rupee that I provide or give to the business has a story to it for sure. As I always ponder on that, there is always a twist, there is always a plot which is to come in the future. And the best of finance leaders or CFOs or CIOs have that ability to understand what is to come in the future. Now, whether everything is possible to be measured, yes, there is a subjective element, but here again, some things where you can't measure, you can't sustain growth, or where you can't sustain without governance, then that growth is inconsistent, right? So that is where the leadership, financial leadership comes into play. And it has to become a culture in everybody in the business, not just the CFO, but again, every business or a functional leader within an organization. Now, coming back to the topic of infrastructure, yes, the REITs and InvIT-backed collaborated infrastructure, be it in roads or in logistics centers or corridors, do help me reduce the concentration of my capital within the fixed assets that I would have placed for my regular operations for sure, so that I can deleverage and invest which makes sense to the business. So that is something which I believe concentration risk is something which has definitely been mitigated or being mitigated through these solutions. And then I would like to talk about the operational risks where I can spend my time more better in growing my business rather than taking care of the operations of a office building or the operations of a warehouse, which is automatically managed by a professionally driven trust in terms of these collaborated ventures. And again, sustainability is something which everybody is talking about right now. That as a risk for me, where I touch upon different points in the ecosystem, be it in terms of packaging or in terms of renewable energy. There is a primary responsibility on companies like mine in FMCG, where I deliver quality products which are eco-friendly. There again, I am able to concentrate. So while growth is on one side, risk management is automatically taken care, just like Ranjita and Rajat have given us assurance as the beneficiaries that these trusts or these ventures, how well they are regulated, so that I can sleep in peace having been associated with such kind of solutions that I might be working in a day-to-day operations. So that way, a well-governed infrastructure definitely helps a CFO keep his or her mind out of these daily routine aspects and getting depth into innovations and digital developments wherein the product's growth lies.
For InvITs and REITs, I would break up risk in three buckets, and I would say that largely it is a de-risked instrument. So firstly, we look at business risk, which is significantly lower because at least 80% of the assets under management have to be operating projects. So that alleviates greenfield risk to a large extent. One has to also evaluate the underlying contract, right? The power purchase agreement or the transmission agreement or the concession agreement in the case of roads. Thankfully, this risk is significantly lower. Today, all of our underlying, because the infrastructure sector now, privatization is close to 2.5 decades old, all of our agreements are fairly robust in terms of, also aligned with international benchmarks. So the first, business risk, is alleviated to a large extent. Second and most important risk is the governance risk, which, whether your asset transfer to the InvIT is fair value or not. So that again depends, and there are large foreign players also in the market which are perceived to have very high governance standards like Blackstone and KKR. So here the fair valuation and how well it is assessed is again a very critical factor. Already we have 50% of the board that is mandated under the InvIT regulations to be independent. So at least these promoters or these related parties do not have too much say. While they do have a say, but the risk is elevated because you have an independent board who is managing these related party transactions. The valuation framework also, second part of governance, the valuation frameworks have also become very robust. If we look at the reports also that have been uploaded in REITs, it's very transparent. In fact, if you read up, if you go to website of any REIT or InvIT, all of the assumptions are laid out in great detail. So one can take a judgment whether this is fairly priced or overpriced, whatever asset. At least the data as such is in place. All of the InvITs today are listed, so there is private or public listing. So all of the LODR guidelines that we see from a SEBI perspective, all of those guidelines are in place and they also apply to InvITs. So there is again transparency in terms of reporting of financial numbers, quarterly reporting, any significant event gets reported to the exchanges. So everything is pretty much in the public domain. Lastly, in terms of credit risk, again for us, the InvIT for the industry, the challenge is to minimize the cost of debt and also reduce refinancing risk. Today, thankfully, the InvITs, all the 25 InvITs today in the market are AAA rated. So the AAA rating again requires a much higher standard in terms of coverage ratios. Again it depends on the sector, but anywhere between 1.5 to 2 times average DSCR is what InvITs are required to maintain. And there is also a cap in terms of the net debt to AUM number. And today all of the InvITs are pretty much around 50% of this net debt to AUM number. 1 or 2 are exceeding 55. But other than that, all of this, the leverage is fairly contained. So all of the risks that happened 10-15 years back, a lot of NPAs that happened in the infrastructure sector. So the government has taken care of that. The regulator has taken care of that, so that the leverage at these InvITs is fairly lower. But having said that, yes, as Gautam correctly mentioned, each of the assumptions has to be constantly tested, sensitivity analysis is done. And what we also do as an InvIT is there are inputs sought from various people, so the project manager, we also have independent risk team which gives their inputs. So all of these assumptions are collated and a pretty robust investment thesis is prepared from an investor perspective.
Thank you. So I think all my fellow panelists has covered the core question what you are asking quite well. So just let me summarize in a little bit generic context and with more inclination to the automotive sector. While I'll try to be closer to the REITs and InvITs. So first and foremost, what we are trying to address here, 2 questions, right? How do we manage and how do we balance? These 2 fundamental questions. So as long as the manage and balance comes, before that each organization will have to decide what is the risk quotient. As an organization, you need to know that what is the level to which you are willing to take the risk. This is something as a board question. At a board level, you define to what extent you want to go, to what extent you want to leverage your balance sheet, to what extent you want to go, which start, class of assets. Now you have done that, you are going on the managing and balancing. Primarily 3, 4 and 5 key factors we got to see. Have a well-defined risk management framework, which means in consultation with the key stakeholders, our knowledge of the industry and the business physicals, please do develop a well-defined risk management framework, which has to consider all the core elements which attribute to the particular business case and also the other factors which may impact depending upon the future development. Okay? Because you are not talking about today, you are talking about the future and the times to come. So that you can keep watch on that. Few things are very relevant today, few things are going to be relevant in the times to come. Second thing is that what you are going to manage is based upon certain information, right? It has to be very objective and data driven. Now, in context of the REITs in particular, the data becomes very, very critical because you are talking about the infrastructure, you are talking about the tolls, you are talking about the hydro projects, you are talking about the solar projects. It depends on lot many factors there. So we need to know what are the major data factors and we need to have the right sources of managing those data in a credible manner. Okay? And in order to do that, the technology is evolving and many of you are very closely linked to the technology side as well. So a lot of things are happening in the space of the data science, predictive analysis. There is already so many models where people are using on day-to-day basis for doing the predictive analysis-based decision making. So we need to be open and open to the learning of the other sides of the business. So there is a very common saying nowadays that the CFOs need to have the CIOs as their best friend. You need to have many of the times coffee together. Because data is playing a very critical role in managing the risk of the business and also understanding how the future trends are going to be. So you need to tell and collaborate with the CIOs how we can leverage best of the tools and technology available while you can contribute from business side. And this can happen in junctions with the business and the people who are working on the ground. So please don't be sitting into your room. If you really want to understand the business, you need to be on the ground, visiting respective facilities, respective plants, talking to the people who are out there working on the line, working on day-to-day job. Don't just think about talking to the next level people or so. Go and interact with many of the people who are working on grounds, supervisor level people. Sometimes a lot of good insights comes when you talk to them, and those are really helpful. So listening and learning is very important. Along with the data, integrate into the risk framework, and make sure these all are correlated and connected with a very robust governance structure. What is already in place, and those governance structures are having continuous listening and learning process. Very well defined listening and learning process. Last but not the least, watch the cash flows. Very famous saying, cash is the king. And you got to watch how the cash flows are going. Is it increasingly improving or deteriorating? In particular, in case of REITs and all, it's supposed to be stable, and over the period of time, since the asset value itself goes down, it comes down. So watch the trend of the cash flows, compare it as against the projections, and also as against the other peer asset class, and then finally integrate the same into your risk framework. So these are some practical tools and techniques which is not only being applied here, but by and large into most of the industries and segments, which helps us to keep a watch on the investment and the risk management of the different class of assets. Thank you.
Thank you. Thank you so much for actually concluding our discussion on the risks that we face. So with this, I think we'll wrap the discussion here. We try to understand how infrastructure is going to have a major impact on India's growth story, as how InvITs and REITs are going to play a major role in making these real estate investor friendly, as well as reducing the role of leverage for corporates and bringing back that capital. And I think we as a country have a lot of way forward in terms of policy, reaching those global standards, so on and so forth. Thank you so much once again from our side. And with this insightful discussion, I am sure that all of us have learned and come out of it a little more knowledgeable. Thank you so much.
We extend our heartfelt gratitude to our dignitaries for enriching this session with their valuable expertise and wisdom, making it truly enlightening for our students. We also extend our gratitude to Dr. Riya Singla ma'am for beautifully moderating the discussion. Now, we would like to call the Finance and Economic Club members for an open dialogue discussion with the panelists.
Good afternoon to our esteemed panelists, directors, sir, our faculty members and our audience. It's an absolute privilege to sit here with you today on the stage. We are incredibly grateful for this opportunity to have this discussion with you.
So I am Saurabh Tiwari, and here I am with my colleague Shefali Tevatia. Over the next few minutes, we are going to have an insightful conversation where we will be delving deeper not only on the topic, but also looking forward to drawing wisdom from their professional journeys. So we have a question for the whole panel, and we invite everyone to share their views. To truly unlock India's infrastructure potential, what is more important? Finding more capital or fixing the underlying problems such as land acquisition and construction permits? So Rajas sir, would you like to add on to it?
I think it is not one over the other. Okay, so all of them are very critical. Okay. So all these resources which are being talked about, whether it's capital, whether it is land or something else, they all are limited to finite resources. So the challenge is how do you make best use of those finite resources. Alright. So that's where it comes into. So for example, when you talk about land, again there are choices to use it, capital. a capital allocator will say which project gives you the maximum return, for example, or risk-adjusted return. Maximum return is or optimum return is something which is a misnomer to put it. It's a risk-adjusted return which everybody has to look at, for example. Right? Okay? So all of them have to be looked into, and it is not that they have to look into silos. They have to look into on an overall basis, because any project would require capital, it would require resources, it would require something else, and shortfall or lack of one of them would affect the project. So it is to be all. Now coming to that, in terms of capital, there have been a lot of initiatives which have taken last few years by the government per se, okay, where they are trying to promote a lot of private capital, which means not only the domestic capital but also the offshore capital coming into the country in terms of policies, etc. They are putting down. Okay, the government also has formed a few institutions to specially promote the financing of and bringing debt capital for these projects. I would say those efforts are the right direction. Are they good enough? Are they meeting the requirement? Answer is no. It is not just because of the abundance or shortage of capital. It's also the risk perception which is also influencing the allocators' approach towards allocating capital. So that's one aspect of it. The other aspect of it could be policy, for example. Right? Okay. Now, given the live example, ECBs today, like the InvITs or REITs cannot raise ECBs because ECBs don't permit further on lending. So how a structure of a REIT or InvIT works, which your colleague showed on the chart, the trust raises debt and then debt is pushed down into the SPV. Okay, so if the trust raises a debt, okay, and ECB guidelines don't permit, for example, further on lending, ECBs cannot be used for REITs and InvITs, and therefore REITs and InvITs are typically depending only on the domestic debt. So recently, last month, RBI has come out with a revised framework of guidelines. Well, it's still a grey area, okay? It is subject to interpretation and lots of clarifications being sought from RBI, okay? But there's one possibility that RBI would allow ECBs for on lending. Similarly, to meet the capital shortfall, okay? Well, there are foreign investors, foreign funds, pension investors, they are coming in. How you operate the domestic capital, for example, right? Okay. The promoters have a limited resource. So again, for example, the government has, as you are aware, NIF is there for the last 8-10 years. The government is now further enhancing the capital of NIF, okay, to where they can invest into the infrastructure projects. Apart from that, government has also taken certain policy initiatives. For example, they have allowed now, investment through FPIs, which can be used for equity induction. Okay, so I can raise NCDs or bonds through foreign portfolio investors and use that as a equity capital. In the revised proposed ECB guidelines, the government is also, for example, allowing or potentially allow, again the ECBs can be released and put as equity, for example, right? Last month, if you've gone through the monetary policy which RBI announced, okay, so RBI has now allowed domestic banks to do financing for M&A, which was so far restricted, for example, right? The RBI has allowed the banks to contribute capital for infrastructure projects, for example. So lot of initiatives being taken in policy framework. Some of them can be taken more. Answer is yes. There could be certain initiatives which can be taken on the tax side, for example, right? Some of the key sectors are still technically not classified as infrastructure sector. Okay. For example, renewable energy or thermal power is infrastructure, but green hydrogen is not infrastructure classified. Okay? If our ambition is to move toward green hydrogen, green ammonia, for example, it is not infrastructure classified. There are certain implications under Income Tax Act, under Companies Act. The moment that sector is classified infrastructure, it leads to better benefit. For example, Section 186 of the Companies Act allows you to fund or give loans without charging interest by the sponsor, for example, right? Income tax exempts certain benefits to infrastructure companies, for example, right? You can have a lower taxation rate, for example, right? Similarly, certain banks or institutions are only formed for funding infrastructure projects. Okay, NAFID is one of the largest infrastructure institutions in India, but they cannot fund, for example, a green hydrogen project. So some of the initiatives are still required. For example, the exposure banks have on power sector also includes renewable energy. There will long pending demand by the sector that please take it RE out of the power sector exposure. There is one policy initiative for example. So there are movements happening. Can something more be done? Yes, it's possible. Maybe the wisdom which we are missing. Okay. Similarly, coming to the resources. How do you optimize your resources? Right? Now we all talk about renewable energy and everything else. One major challenge I think nobody talks about is that we are converting a lot of the green land into non-agrarian land, for example, right? Today farmers are, because they get so much of value, they are more than happy to sell, अगर मैं हिंदी में बोलूँ 1 फसली 2 फसली 3 फसली को लोग बेच देते हैं, ठीक है? So that is one challenge which is coming on and creating extra pressure on land, for example. Okay? So those are the aspects we all need to think through. But yes, all of them are very relevant. They have to do it together. There is nothing like one over power. Okay? And I'm pretty sure there is a lot of consciousness which is coming amongst the policy makers, the government, okay, on these aspects. There's consciousness coming from the developer side. There's a lot of focus on the ESG side, for example, right? When we displace a farmer taking his land, all right, it is not only one-time compensation, for example, we provide them sustainable remuneration or employment. When I talk about sustainability, sustainability is not in terms of a green project. Sustainability is something doing anything on a recurring basis. Okay? It could be, what you are doing in a daily life. This is sustainable. Maybe stocking 20 hours a day. This is sustainable, for example, right? So sustainability has to look into that aspect. So that's my view in general on all these aspects. Okay, I'm not going to be specific, but generally all these are very critical, have to be looked upon. Okay? There are certain factors which could be in our control, which could be, so between capital and land, for example, capital still can be generated, land can be. So those are the aspects which we need to evolve and think.
Rajat has listed down a lot of initiatives-based viewpoints. So you asked about capital and land. I have, or resources. I have a slightly different view on this. So, as just Rajat mentioned, a lot of tools, a lot of enablers, a lot of things are happening today, and we are lucky to see them all happening in one time and one place. But I also want to add one more layer to it, intent. So today there is intent. Government intends to grow into an economy in a certain fashion and bringing in a lot of enablers which you just mentioned. Now, whether that intent is passed on or percolated to every level, down till the, you call it an MSME organization or a small-time entity, whether it's getting percolated and whether the intent is aligned across these layers, so that you plug in, you can, the resources that you just have, you just mentioned, be it capital or the physical resources that we have, whether they are properly interlinked so that the intent is achieved. So that today it is there, whether tomorrow it's going to continue, whether the consistency is going to be there, it all depends on us now. So that, because as we said, just like physical infra is no more a government's baby, it's now come as part of every private investor as well. The intent also has to be across the communities, be it in corporate world or businesses or in private investments. I feel that intent needs to be consistent, and government policies need to ensure that it's directed in that manner, irrespective of who is sitting in the helm or who is drawing those policies.
I agree with what Rajat has said, that essentially both of these I agree with what Rajendra said. Inherently, both of these feed off each other, and it's not one over the other as such. I believe that there is no dearth of capital, provided that some of these risks are addressed, and there are different pools of capital for different levels of risk. Right? So there is, and your returns, the kind of investor returns are a function of what is the risk that you take on this particular pool of capital. So you create it on a scale, and there are different. So there's a developer who will take a certain level of risk, in terms of the various issues that he will have to face. On the other end of the spectrum, there is the insurance and the pension companies who cannot live with a certain level of risk. So yes, fixing the infrastructure issues is very critical, and I think the capital will soon follow.
Thank you. Going back to the question, do we need policy reforms or we need investment? I think the answer is yes. Now to connect the same with the one live example from my experience, a bit dated example. In Delhi, in 2002, power was a major concern. Okay, there was frequent outages. The utility company that time, the Delhi Desu Utility or Delhi Vijay Board, they were running with the operating AT&C, aggregate transmission capacity loss of 53%. Means every 100 unit procured, 53 was in loss, 47 was against. So the utility company was bleeding, and that brought into the reform. So power sector was going through reform at that time. That reform led to two fundamental practices. One is that you unbundle the power distribution entity from the other segments of the business, notably transmission, generation. These two you have to unbundle. And this all comes within the state sector, not the central one, because central has the larger power plant from where the grid corporations transmits 30 kV lines to the state, and the state is having their downloading the control. They will be having their own transmission framework, and few states are having their own transmission generation companies also. Now, why it was fundamental to be done? Because generation company was doing good. They were good, efficient power plants. Usually, manufacturing is being measured. As I was telling that world-class manufacturing. I see every sector which I go, fundamental prevails. People do it some or the other way, be it power or the automotive or anything else. So power plants were doing good. NTPC was one of the best. The state power plants were also okay. Gas-based power plant was the best. Transmission was also good, because there is some losses in the transmission line, but the transmission lines, transpose was doing good within the states also. But when it comes about the distribution companies, there was major issues. The revenue leakages, the pilferages, the theft, the nexus, political issues and all. So first, the major reform came. Can you imagine, I think many of you would be tracking the power sector closely. What would be the AT&C loss of the Delhi Transco, the company I used to work for now called TPDDL, Tata Power Delhi Distribution Limited. What would be, just guess about the AT&C loss of the last closed business? As against 53%. By the way, I am putting one more context here. There is a certain AT&C loss will always exist. Global benchmark is about 9 to 10% because there is a losses which is coming through the wiring processes and delivery process. Now the number right now is less than 20%. I think 18% or so, but is less than 20% consistently. Still there is room to grow. It will grow, but less than 20%. Now, had it been possible, just by putting in money of replacing transformers, cables, etc. No. Had the private equity would have came, because that time the government invited the major industrial hubs, they were very reluctant. And I am given to understand from my informal sources that in fact the central government has to intervene to ask to some of the business houses to come and participate. Today if you see, Odisha has been privatized in terms of distribution. Many of the other countries, including into Maharashtra, there is a privatization already happening, and huge amount of the, because power is very capital intensive, not only generation but distribution costs a lot of money. Huge fund is flowing into it. So we need to pave a way to to make things work. So investment comes when you have the right ecosystem. It's like just getting a seed growing to a plant. You need to have the right environment. Otherwise, seed can still be there, but it won't come and become a plant here. That infrastructure to start with is the policy framework, consistency of the policy, surety of not having the abrupt changes. These are fundamental in order to bring in the large capital. We can still have the incremental, but if you want a large capital to flow into an economy, then you need to have a very good policy framework and the good progressive world benchmark ecosystem. Today, as we speak, our ease of doing business is what? We are the fourth or fifth largest economy in the world. But what is our ease of doing business? Global ranking. 63. 63, right? Now, one can debate, because these numbers often get debated. Why 63? Because sometimes when you see the comparison, you see many countries which is coming as surprise. But we still have got a lot of roadblocks, and that is why we are not breaking the trajectory of the GDP growth of below 7% or so. Besides having a potential to grow more than 10%. Now to conclude here, we definitely need the policy reforms and a consistent policy reforms in the areas of the same. Okay, it is happening with some pace, but there is a lot more to be done. Okay, results are evident. I quoted one example, there could be a couple of more. I mean, from the same, my current industry, I can quote EV example. Couple of years back, we were talking about EVs with a very low patent. And then there was three major reforms came. Some in the form of incentive, few other in form of giving the ecosystem to generate the whole ecosystem of battery and other industries. And then, in order to have the consumers being affordable, there is a whole ecosystem is built up wherein the state governments are offering the power at a subsidized rate. For example, like in Maharashtra, if you buy, in my own society, if you buy power for the charging your cars, you will be charged as 7 rupees per unit. But if you are buying for your own house, since it is inverted rate, it costs you 60 rupees. Similarly, in the registrations, you get some subsidy. You get the subsidies while you procure some batteries and in terms of the sourcing and other elements. So this whole ecosystem coming up. And then you see the OEMs are bringing in the money. You see the JSW has announced a big plans to put into the both battery as well as the the EV infrastructure. The large industrial group, including the Reliance, is putting money in the battery infrastructure. All of this is happening because you got an ecosystem infrastructure being created and supported by some stimulus here. So answer is that we are at the right time in this country where a lot of things are happening. We should not be complacent that things are happening, everything, and now we just need investment. Because investment is a fallout. I don't see investment is something you can ask the investor to put in the money unless you have the ecosystem being there. And if you have the ecosystem being there, the global investment ecosystem work naturally. It's like a water. It flows where they have got the more potential. Okay? Where there's more opportunity, where there's more yield potential with the balances, the investment flows. So that is how I see this topic emerging in.
Thank you all for your valuable perspectives. Now, moving forward, we have a question for all of you, which I think our audience is also very keen to hear. So, looking back at your journeys, what is one piece of advice that you have learned that you wish someone had told you when you were at our stage, that is at the beginning of your professional journey? So, Gautam sir, would you be open to taking this first?
Yeah. So when I was at your age, obviously we all was thinking that the sky is the limit, we can do it. Okay. Key here is that to focus. Okay. There's no shortcut in the life. There's absolutely no shortcut in life. You have to grow, and you have to grow by learning, hard work, dedications, and open mind. Now, over 2 decades back, during our student time, it was not that information was not that publicly available. We are not having this kind of conferences also. I think you are also privileged to be part of the IIM Amritsar, which is getting very good exposure. Now, maybe 1 or 2 things what you should be mindful is that be grounded. Okay? Be very expressive, but be very grounded. Learn what you have. Okay? One thing which I see with the professionals coming out nowadays, they don't bring the depth They just want to have everything. In that process, they don't have the adequate amount of the depth being up. If you really want to grow well in the industry, you really need to know well, build a depth in the topic you are dealing with, contribute, put your imprint, bring in some incremental improvement in what you are doing, and then move on to take something new. This incremental innovation mindset and the incremental progressions brings a very exponential growth actually in the life.
Just three things from my side. One is obviously work very, very hard. There is no shortcut at all. I mean, I'm working for 23 years. I work as hard as what I did when I started off. So obviously there is, hard work always obviously reaps its results. Second thing is, just maintain your relationships, be it with your college alumni as you go forward in your career. Maintain relationships and good relationships with everybody. And lastly, I think at least for the girls, at least I've not seen, pretty much, people put up your hand for various things, for various leadership things. At least whatever I've observed in my organization, a lot of the girls are very hesitant to take up new initiatives, to put up their hand and speak up. So at least, at least for to drive the next generation of women leaders, it's very important for the women to come forward and kind of just be out there.
What I would have learned during this 20 years, keep your basics strong, irrespective of where you are, where you work, what you do as an entrepreneur or an employee of another organization. Have your basics strong. Because without basics, we would not be able to talk or collaborate or partner with business and to bring out the data that is properly needed to take the right decision. So basics definitely need to be strong. Integrity, as everyone said, there is no shortcut to success. Integrity has to be built into our culture, no matter what the surroundings are. Don't look out for short-term successes. For long-term, it is always good to maintain that integrity. And I would second again what Ranjita said around women presenting themselves with confidence on their abilities, because what I have seen is that there is no lack of competency between the genders, but the way it is portrayed or brought forward in an organization, it makes a lot of difference. Please do come forward and look at the bigger picture, then share your thoughts, whether it's good or whether it's right or wrong. Please put forth your thoughts and views. Someday it would click, and that would be the point where there's no looking back and you will fly to your success.
I think the most important thing is to be good human being. Okay. I'm saying people, you all talk about professional, we talk about education, we talk about health, but I think the most important thing is to be a good human being. That's the first thing. And the second thing in my view is whatever you do, okay? It's every day, whatever you will do. You will be studying today, you will be working somewhere else, you will be doing one assignment someday, next assignment someday. Do put in your best. So at the end of the day, when you go to sleep with your hand on your heart, you have that satisfaction that you have done your best. That's the point. You do whatever you do for your own satisfaction, not to seek, a confirmation or solicit some, clappings or whatever it is. While it helps, I'm not saying that, recognition and appreciation does help. But ultimately, at the end of the day, if you have done your best and you are satisfied with the hand on your heart, that is matters the most. And a good human being, okay? You may be penalized for being a good human being. I can tell you that. Life is always not fair, all right? But in the long run, all right, when you look back, that will give you the immense satisfaction. That is my learning from it.
thank you everyone for your valuable insights. I guess everybody has learned a lot from your learnings and experiences. Your perspectives bridging the automotive, energy, FMCG, and renewable power sectors have given us a truly holistic view of the topic.
We are immensely grateful for your time today and the wisdom you shared with us. Thank you so much.
Thank you so much, Team FSC. Also, thank you to our insightful and engaging panelists for addressing all the questions with such clarity and enthusiasm. You may now take your seat in the audience and continue enjoying the rest of the conclave. We would now like to invite Ms. Gitika to conclude the conclave.
Good afternoon, everyone. I am Gitika, and it's an absolute honor to reflect and enrich this discussion with all the thoughts that we have witnessed under the finance theme of Pariprekshya 2025, the 9th annual finance and marketing conclave of IIM Amritsar. This session has been a thoughtful exploration of how finance today drives purpose, resilience, and long-term creation. Each of our esteemed speakers offered perspectives that deepen our understanding of how financial leadership shapes today's dynamic business environment. Our first speaker, Mr. Gautam Pandey, opened the session by shedding light on India's infrastructure and how it cannot be driven by the government alone, but by sustained private investments. He emphasized that strengthening the manufacturing and service sector in the country and making